Co-op versus condo. What every New York City buyer needs to know before they start looking. Before I take a buyer out to look at apartments in Manhattan, there's one conversation we always have first: co-op or condo. Because if you don't understand the difference before you walk through the first door, you're gonna waste a lot of time and potentially fall in love with something you can't actually buy. I've been doing this for 18 years, and I can tell you that the co-op versus condo question is not a small detail. It shapes your entire search. It affects your budget, your timeline, your closing costs, and what you can actually do with the apartment once you own it. So let me break this down the way I break it down with every single buyer before we go out, because this is the conversation that changes everything. First, the basic. About 70% of Manhattan's available inventory is co-op. That means the majority of what you're going to see when you start looking is co-ops, not condos. So understanding how they work is not optional. Here's the simplest way to think about it. A co-op is like buying into a country club that happens to own your apartment. You're not buying the physical unit. You're buying shares in a corporation, and those shares give you the right to live there. The building, through its board, gets to approve you before you can buy. They will review your finances, your income, your assets, your references, sometimes your lifestyle. And they can say, no, a condo is different. You actually own the four walls. You have a deed to the real property. There's no board approval to buy. You own it, and within reason, you do what you want with it. That freedom comes at a price, a real one. Let me give you real numbers so this is concrete. A one-bedroom co-op in Manhattan is going to run you roughly around $700,000. A comparable one-bedroom condo, same neighborhood, maybe smaller size, is going to be closer to $1.2 million. That's a meaningful gap, and it exists for a reason. Condo premium is partly freedom, partly financing flexibility, and partly closing costs. Because when you buy a condo with a mortgage, your closing costs are significantly higher than on a co-op. We're talking roughly 4 to 6% of the purchase price in closing costs for a financed condo versus closer to 1 to 2% for a co-op. The reason is the mortgage recording tax. When you finance a condo, you pay a tax to record the mortgage against the property, nearly 2% of your loan amount. On a $900,000 mortgage, that's close to $17,000 right there, due at closing in cash. Co-ops are exempt from that tax entirely because legally you're not buying real property, you're buying shares. So no mortgage recording tax, as I previously mentioned. That is one of the most significant financial differences between the two structures. And most buyers don't know about it until they are already in contract. That's exactly why we talk about it first. Now let's talk about what the co-op board actually wants from you. Every co-op is different, but there are common requirements across most buildings. Most co-ops want a minimum of 20% down. There are more selective buildings on Fifth Avenue or Park Avenue that want 50% down or all cash. They do set their own rules. They look at your debt to income ratio like all co-ops do. They want to know that your total monthly obligations, mortgage, maintenance, everything else are a manageable percentage of your income. Their threshold is typically stricter than what your bank would approve. They want to know that you have money left after closing. All co-ops do, not just enough to buy the apartment, enough to live comfortably without financial strain. This is what's called post-closing liquidity. Think of it as the board asking, if you lost your job tomorrow, could you still pay your maintenance for the next year or two? They want the answer to be absolutely yes. And if you have a dog, they also want to know the breed, the weight. The buildings have restrictions on breeds and sizes. This is not something you find out after you fall in love with the apartment. This is something we address before you ever go out looking, and it's very important to do. Let's peel the onion on a co-op timeline for a second. When you buy a condo, closing typically takes 60 to 90 days. When you buy a co-op, plan for 90 to 120 days. This is approximate, and it could sometimes take longer because after your offer is accepted and contracts are signed, you still have to submit a full board package and wait for the board to review it, interview you, and issue their decision. The board package is quite extensive. Tax returns, bank statements, employment verification, personal, professional, reference letters, financial statement. It takes time to compile and time to review, and the board can still say no, even after all of that. That is the reality of buying a co-op in New York City. And it's not a reason to avoid them. Co-ops offer real value, lower entry costs, and some of the most desirable buildings in the city are co-ops. But you need to go in with your eyes open. Here's how I think about it with buyers. If you want maximum flexibility to sublet freely, to sell without board approval, to close faster, a condo is worth the premium. You're paying for freedom. If your finances are strong, your timeline is flexible, and you want to maximize what you can get for your budget, a co-op gets you significantly more apartment for the money. You're trading some control for value. Neither is the right answer for everyone. It really depends on your situation and your timeline and what you're actually trying to accomplish. That's why this conversation happens before we ever go out looking for apartments, not after. If you want to walk through which structure makes sense for your specific situation, comment the word decode below and I'll send you my co-op versus condo buyer checklist. No surprises, just the information you need before you start your search.